The Dow dropped 500 points, and it's the best gauge of today's stock market carnage. The old approach just got more expensive. The practical edge now comes from changing process, timing, and tooling together. We will map trigger, incentive shift, and downstream impact before the close. That's how much the Dow Jones Industrial Average just fell, and it's not the headline number everyone should be watching. Here's the critical distinction. When the Dow drops 500 points, most investors think in percentages. They calculate point drop divided by current index level. But that's exactly the wrong lens for what's happening right now. The Dow isn't just a price index. It's a signal of institutional conviction. It's 30 blue-chip stocks, the companies that have the deepest capital, the longest operational history, and the most insulation from volatility. When the Dow moves 500 points, it doesn't mean the market shifted by 1.5%. It means the companies with the most stable cash flows just repriced their futures simultaneously. That's different from a tech-heavy index collapse. That's different from a retail-driven panic sell. That's structural reassessment. Why does this matter? Because the Dow is your early warning system for what institutional money believes about the next 6 months. The S&P 500 can stay resilient if tech stocks rally hard enough. The Nasdaq can spike if AI enthusiasm overrides everything else. But the Dow reflects consensus among the companies that own real estate, operate supply chains, pay dividends, and employ millions of people. When the Dow drops 500 points, what's actually shifting is the expectation around corporate earnings, interest rates, and the cost of capital. Let's zoom into the mechanism. The Dow components are heavily weighted toward financial services, industrials, and consumer discretionary. When these sectors reprice simultaneously, it signals one of three things: either the Fed's rate path is being reevaluated, or earnings expectations are contracting, or both. Right now, all three are in motion. Consider the earnings narrative. Over the last 8 quarters, corporate guidance has shifted from growth at all costs to show me the margin. Companies that benefited from the zero-rate era, especially those with high leverage or long-duration assets, are now facing a reset. The Dow's 500-point drop isn't a panic. It's the market's way of saying, we're recalculating what these balance sheets are worth in a higher-rate environment. Here's the second insight that most analysis misses. The Dow's move is also a vote on monetary policy expectations. If investors believe the Fed would cut rates aggressively over the next 4 quarters, the Dow wouldn't fall 500 points on a day when inflation data comes in hot or employment stays strong. The fact that it did tells you something crucial: institutional money is pricing in a higher-for-longer interest rate regime. They're not betting on a soft landing followed by 3 rate cuts. They're bracing for stability at elevated rates, which means lower multiples, lower consumer spending, and lower earnings growth. Now, what changes next? Watch 3 things over the next 72 hours. First, the bond market's reaction. If the 10-year Treasury yield stays above 4.3%, the Dow's weakness is likely to extend. Why? Because it confirms that the rate cut narrative is dead. Every basis point matters for the companies in the Dow. Higher rates directly compress their valuation multiples. Second, earnings revisions. Over the next 10 trading days, expect major banks and industrial companies to start guiding lower for full-year earnings. This is when the market starts pricing in the recession thesis, not the soft landing thesis. The Dow's initial 500-point drop is just the opening move. Third, credit spreads. If the Dow's weakness is accompanied by widening credit spreads, especially in investment-grade corporate bonds, then what we're seeing is contagion from equities into credit markets. That's the signal that institutional money is genuinely worried about balance sheet stress, not just multiple compression. Here's the contrarian angle. The Dow's 500-point drop might actually be a healthy recalibration. For the last 18 months, the market has been pricing in a narrative that never made sense: rapid AI productivity gains plus stable corporate margins plus falling rates. That story was always fiction. The Dow's drop is the market finally admitting it. The practical next action: if you own index funds or dividend stocks, this is the moment to ask yourself one question. Are you positioned for earnings growth in a higher rate environment? Or are you still holding assets that depend on multiple expansion and falling rates? The Dow just answered that question for you. It said, we're repricing for earnings, not multiples. That's a fundamental shift in how capital is being allocated. Watch the Dow over the next week. It's not just a number. It's the consensus view of what the economy looks like 6 months from now. And that view just got significantly more cautious. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next.